So we've talked about the AI trade, we've talked about chips, but here's another market signal that you should not, cannot ignore: IPOs. Take a look at this chart. It really puts it in perspective. Through just the first half of 2025, we've already seen more US IPOs by absolute number than any full year since the pandemic bubble burst. Yes, 2021 is missing, not because it was forgettable, but because that was a full blown anomaly. Over 500 IPOs by that time this year. You had meme stocks, you had SPACs, you had free money, the ZERP era. Remember that? 2021 broke the scale. But now we're so back. Companies once left for dead, like Lime, they're suddenly back in the mix. Remember Lime? It's the scooter company that had to take a down round just to survive in 2020. Now it's got cash flow, growth, bankers, and companies that have gone public over the last year, like CoreWeave and Circle, they have more than doubled since debuting. Not every name, though, is getting rewarded. This market has favorites and memory like a goldfish. So the question is, are we entering a sustainable reopening for IPOs or just chasing another short-term pop? Let's bring in Dave Chen. He is head of global technology investment banking for Morgan Stanley to break it all down. Dave, thank you very much for being with us today. What a year. I feel like we spent the last few years kind of in fits and stops, maybe getting towards the IPO window opening, but it feels like it's truly open right now.
Yeah, absolutely. Yeah, you have some great numbers there, Deirdre. If you just look at your numbers were US IPOs. If you look at just tech specifically, in 2021, we had 124 tech IPOs, and then we just crawled our way back in terms of the last 3-4 years, right? In 2022, we had 2. And then last year, 9 deals. And then this year, since January 1st, we've had 8 tech IPOs. 3 more are publicly filed. And so we're on track for having our best tech IPO year yet in the last several years.
It goes against the macro environment, right? This year has been so volatile, and that's not typically a time when companies want to test public markets. We've had tariffs, we've had geopolitics. So what is it about this year that sort of sent IPOs off to the races?
Yeah, I think it's really stabilization post Liberation Day. I think valuation levels have also returned to attractive relative entry points, where I think owners, venture capitalists, private equity firms are now willing to sell stock at, given, we've seen about a 20% bump in the markets since the lows of this year. And I think it's really kind of Deirdre, supply demand imbalance, has created a strong market from the institutional bid perspective to look at emerging growth IPOs. But look, make no mistake, we advise our clients that these windows open and close, and so right. You got to really get ready to have a maximum chance to kind of launch in an open window.
So does that mean that you're advising sort of companies that may be thinking about thinking about going public to do that now? Now's the time. They could miss that window, and what are the consequences of missing it?
It takes to get our companies public. It's a 2-year process, Deirdre. We typically go and do non-deal roadshows and see investors, and we typically want to see basically the top 25 investors, the human beings that actually would be making decisions on the IPO at least twice before you even launch the IPO. So that's the point, is that you can't just all of a sudden wake up and decide you want to go public.
So a lot of the companies, the big tech companies that are still private that I talk to, they always say that they're ready to go public, but they don't necessarily want to go public. Especially a company like a Stripe or a Databricks or an OpenAI that's so big that has sort of robust financials internally, what does it take for them to go public?
I share your sentiment. I think I certainly agree. I think it's not a demand problem, Deirdre. I think investors would welcome IPOs in this space. There have been some successful deals in AI, our deals like CoreWeave and Astera Labs.
Right.
It's really the supply side, really. I think it's one, the ability to raise capital in the private markets is strong, and then 2, I think these AI companies, they are basically tinkering with a lot of business models. And so as a result, it's better to stay private in order to actually figure out what the business model actually will stick. So I think what it's going to take, I think more maturity in their business models, more predictability financially. And then I think, moving to a point where we actually have real production workloads in the enterprise we actually put out a report that said like 60% of companies are going to be having at least one production workload by 2025. And so that will, I think, enable companies that are supplying the technology to enterprises to go public with predictable business models and durable demand.
I mean, you mentioned CoreWeave. Look at it. It's just been like off to the races, right? This has been such a success story. And this is part of the reason for that is because it's kind of like one of these pure AI plays, right?
Right.
In theory, it should encourage a lot of these companies like a Databricks, like an OpenAI, like some of the, smaller ones that are raising tons of money, billions of dollars in the private markets to go public. But there's also, and this is what I hear living here, talking to founders and CEOs of these private companies, it's not the milestone that it used to be, right? It almost feels like this hamster wheel. They get into quarterly earnings and you have to build in public when it can be more comfortable to build in private, especially if there's so much money in the private markets. What do you say to them?
I think once again, I think, a lot of these AI business models, a lot of the products that they're debuting, when you look at the core underlying, unit economics, they're pretty low gross margins today. And so I actually really think that these businesses aren't ready to actually go public with a predictable financial model. I do think I wouldn't underestimate just the power once you actually are ready, the power of the commercial acceleration that an IPO brings. I've seen it a lot with a lot of my clients. And then third, I think just when you think about just the bar to go public, I think it's just really, everyone always asks me, hey, what's that bar? And, I think there's this general notion, Deirdre, that, companies think that the bars just keep getting higher and higher. I think we have to be very careful just kind of putting out absolute numbers. I think fund managers are looking for, companies that can, compound growth in a durable fashion, 30%. If you can do 30% growth and you're big enough to be predictable, you don't have to be massive. And so, there have been some really interesting IPOs recently, like a Mountain or Hinge Health, that have been market caps like, around 2.5 billion or less. So, I'm hopeful we're going to see a supply of companies, in the next 12 months that you don't have to wait until you're $1 billion to go public.
So you mentioned growth. I feel like that was sort of the most important thing a few years ago when we saw that 2021 boom, and then the focus was sort of put on profitability. What is it right now? Is it growth? Is it profitability? Is it narrative? Or is it something else that investors are prioritizing in this cycle?
Yeah, obviously, it's not quite as frothy as we were in 2021 by any stretch. I think investors are a lot more balanced on growth and profitability versus growth at all costs in 2021.
Right.
We survey investors, Deirdre, very frequently on what they want. And maybe I'll ask you the question. We basically ask them, hey, what do you want? 40% growth and 0% margin, 30 and 10, 20 and 20, or 10% growth and 30% margin? Which one do you think is most preferred?
I mean, they probably want a trade-off, right? Reasonable growth with some profitability.
You're right on the money. So obviously in 2021, it was 40 and 0.
Yeah.
Today, it's pretty
It's wild.
balanced between 30 and 10 and 20 and 20, actually with a slight leaning toward 2020. So another stat I'll give you, like when we look at correlations on revenue growth versus free cash flow margin and, their contribution to revenue multiple, right now, about 1% revenue growth is about 1.5 times more influential than free cash flow margin. So investors are still rewarding growth, but it's got to be efficient, and you need a clear path of profitability.
My banner on my YouTube page, if you've seen it, David, says adjusted EBITDA does not equal GAAP profitability. So, I hear this. It's got to be some kind of trade-off. But when you look at, for example, like I'm going to go to a Circle, right? And this is in the crypto space, which maybe has a bigger appetite for speculation, for growth, for less profitability. But I mean, it has just been wild, the run that it's been on since its IPO. Maybe we can pull up a chart of Circle to see how much the stablecoin company has boomed in public markets. What does that tell you about pricing IPOs? I mean, you mentioned or alluded to that a lot of companies took down rounds to get into the market, but in the case of like a Circle or a CoreWeave, a lot of that has just gone up once they become public, that value.
I think from a pricing perspective, a lot of what I think you're alluding to the kind of the pop that happens. Look, I think
Well, pop, yes, but also like the weeks after, right? We'll talk about the first day pop in a moment.
I think there's a really interesting, you know, secular, theme in that space in general, and that's definitely what we haven't seen in a long time. And I think on the crypto side, there's just this secular shift to digital assets, and I think we just need, as customers and companies, a faster way to settle. The regulatory environment has actually clarified, and that's also driven, I think, what you're alluding to is kind of enthusiasm in the space. You've seen like the U.S. announced like a strategic Bitcoin reserve,
Right.
got a stable coin bill out there. So all of this stuff, it basically enables investors. Typically, investors don't really have that many pure play ways to play crypto. And so, given the success of recent fintech IPOs, I think we've got a robust backlog of crypto companies to go public in the next 12 to 24 months.
What does the rest of the year look like? Are they encouraged, as you sort of alluded to, by Circle? And I mean, you also have Chime on the other side, which hasn't quite performed as well.
Very, 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 decent performance out of the gate for Chime, and I think in general, absolutely, along with other really interesting themes in tech, absolutely, crypto is a new theme that I think is going to be important. I think AI will be bigger, but it'll be important.
Okay, and then on the AI front, when do we start to see more? When do they sort of have that more stable revenue growth, more stable profitability? Do you think that happens next year or further off?
I think it's next year. I think, once again, I think a lot of the startups that we talk to, they're growing incredibly quickly, but they're definitely investing for growth, and I think they're benefited by actually staying private to kind of test these business models out. I think also on the demand side, the demand is getting there. As I've mentioned, kind of that 60% stat. That's great, but that's for calendar 25, and so I think we need, all companies, large Fortune 500 companies, to be putting in place, 10s, 20, 30 different workloads from a commercial production basis. I think in 2026 and beyond, I think companies are also going to change their mindset. They're changing their mindset from, hey, let me use AI to save some costs here and there, to actually AI is going to be an existential, item in my competitive advantage. And so when we get there, that's going to enable, a landslide of companies in AI to go public.
Are you seeing that? I mean, how much is AI efficiencies, right? Productivity, not even for just tech companies. How much is that impacting, that balance that you talked about, where you balance, say 20% growth, 20% profitability margins?
Honestly, like, I think the 2020 stat that I had mentioned is applicable, frankly, for the broader tech community. Let's take the average software company trying to go public. That is more typical of what you've seen in the last 5 to 7 years. Frankly, my opinion is, if when we actually take out some of the most exciting AI companies, the 2020 rule is not what investors are going to be looking for. They're going to be looking for the companies that have, if you look back in the last 10, 15 years, the $1 trillion market cap companies today, when they were going public, they weren't going 2020. They were basically 40 and 0 or 40 and very negative for a very long period of time.
Let me see if we can do something here on the fly. Jeff Richards, we're going to talk to him later on the show, but he's so good and smart on IPOs. He's a good friend of the DB live stream. Jeff, can we bring you in? Question for Dave. I know you guys are pals, but you still got to ask him tough questions.
Yeah, Dave, how are you?
There he is.
Good to see you.
I think your point about growth, I mean, maybe you could share a little bit of what you're seeing in the private markets. One of the comments that I make frequently is, if some of the companies like Anthropic and OpenAI and Databricks were public investors would have a much better understanding of what's happening with AI. I continually hear from public investors, gee, we don't know if this is overhyped. We're not sure why all these hyperscalers are spending all this money in CapEx. When is it going to show up in software revenue? And my answer is, you're just not seeing the companies that are benefiting in this first wave. And so maybe one thought to Deirdre's question is, when do you anticipate some of those companies trying to go public? It's probably not a 25 timeframe, but is it 26? Is it 27? Because to me, it just opens up a much broader narrative about the impact of AI on a much broader audience.
I think it's going to be, you know, a couple of years out. I think even those businesses, I would say are incredibly large. They're scaling very, very fast, but the overall dynamic environment around them, has them once again, they're testing business models and new products. They're making acquisitions, as Deirdre has reported on very recently, as fast as some of the smaller startups. And so they're just a larger version of that. And so I think IPO investors certainly would welcome those companies to go public sooner. But I think they themselves just have a lot to figure out in terms of to get a little more predictable and visible.
Thank you for bringing up the M&A environment, because we are sort of seeing this trade-off. We talked a few weeks ago as well about burnout. And I mean, the mega caps, right? They are so well capitalized, and it feels like we're entering into maybe a different regulatory environment. You saw the massive Google acquisition of Wiz. What's your outlook here, and what do you sort of advise companies to that are weighing between IPO or maybe a massive M&A deal?
Sure. Yeah, my favorite topic. So yeah, I think M&A volumes are off to a great start. So once again, kind of similar to what we talked about in the IPO theme, we've seen the same thing in M&A. So M&A environment today, we're at 180 billion. That's up 25% from last year, and also the deal sizes are getting bigger. So the average deal size is up, about 22%, about $1.4 billion. And what's driving this? I think really three things I always think drive the M&A market: CEO confidence, the financing environment, and then basically seller willingness to transact. I think on the CEO confidence side, strategics are back. Of the last 20 deals above $1 billion, 60% have been strategic. From a financing perspective, like, it's very, very robust out there. We're seeing just very strong terms across all asset classes, investment grade, high yield, convert.
Right.
Just in the convert side alone, we've seen 14 deals at a zero coupon, which basically harkens back to the level of investor demand like we saw in 2021. And then finally, just like sellers, they're able to negotiate off of a more reasonable valuation,
Right.
given we've seen the 20% bump since Liberation Day.
So the message is, on the M&A front, on the IPO front, we are so back for now. Jeff, thanks for dropping in. We're going to see you soon, so don't go too far. Dave, wonderful to have you on. Thank you so much for joining. Talk to you very soon.